Today's topic is on home renovations. Renovating your home can be a great way to add value, make your home more comfortable to live in, and even help with your mortgage payment. However, financing a home renovation can be very challenging. In today's video, we'll explore a few different ways to go about doing it. The first option for financing a home renovation is the most obvious: cash. You can finance a home renovation through personal savings or through a gift from family. This is a great way to go about doing it because you won't incur any interest, costs, or loan fees for any kind of borrowing. If you have the cash or access to it, this is by far the best way to go. If you don't have the cash to finance your home renovation, the next easiest way to do it is to use your credit cards. Now, putting home renovation on your credit card is a very costly way of doing it. The interest rates are almost always higher than any other option. So of course, if you do go about this route, make sure you have a good plan to pay it off quickly. Otherwise, the cost of the interest on your home renovation could well exceed the cost of the renovation itself. You can also get a personal loan from your bank or credit union. This type of loan can be used for anything. Typically, people will use them for consolidation or for car loans. However, the interest rates are higher than most types of loans other than credit cards. Again, this is a possible option, but the interest rates are going to be very high. A home equity line of credit, or HELOC, works much like a credit card. You borrow money as you need it and pay it back over time. Now, the difference between a HELOC and a credit card is that typically the HELOC will be available for much larger amounts than for a credit card or personal loan, and because it's secured against the equity in your home, it's typically available at much lower interest rates. A HELOC is a great option if you don't know exactly how much you're going to spend, or exactly how long the renovation is going to take place, or when exactly you can pay it back. The final form of financing is the home equity loan. Like the home equity line of credit, it's secured against the value of your home and is therefore available in larger amounts and at lower interest rates than the other types of financing. Furthermore, the home equity loan generally gets you a better interest rate than the home equity line of credit. A home equity loan typically comes as a single advance and is repaid back over time like any other mortgage. The home equity loan can come in two forms: a refinance of your existing mortgage, or adding on a second mortgage behind your existing mortgage. If you're going the refinance route, take note that redoing your existing mortgage is typically going to cost you some kind of penalty for breaking it. Although, if you do it with the same lender, these penalties are often negotiable. And even then, you can look at doing something like a blend and extend to get around the mortgage penalty entirely. However, your interest rate will be a little bit higher. Similarly, if you go to a second mortgage, leaving the first mortgage intact, you're going to pay a much higher interest rate on that second mortgage. Which of the two options between refinancing your existing mortgage or adding a second mortgage makes the most sense for you is going to depend on the size of your existing mortgage, how much more money you're going to need for your renovation, the interest rates that you have on your existing mortgage, and prevailing rates at the time, as well as possible penalties, legal fees, and other costs. But we're not done yet. In the case where you're buying a home, you can often include the cost of renovations in your mortgage. This is particularly popular if you're buying a single-family home and you want to add a mortgage helper suite in the basement. Now, the way this works is that the cost of the renovations is added to the purchase price. So if you were buying a home for $1 million and putting in $100,000 worth of renovations, the value for lending purposes would be $1.1 million. That is, the mortgage amount, down payment, qualification, and everything else is as if the purchase price was $1.1 million. Mechanically, the way this works is that you need to get a firm quote from a third-party contractor. So make sure that you allow for a site visit in your purchase agreement. The contractor goes in and provides a quote, and then you provide it to the lender and they authorize the higher mortgage amount. When it comes to the funding date, your lawyer will advance your mortgage but hold back the amount of the renovations. So in the case of the $100,000 renovation project, they would give you your full mortgage but hold back $100,000 until the completion of renovations. In order to better understand this, we'll flesh out our example a little more. The $1 million purchase price plus $100,000 in renovations. Let us further assume that you have $250,000 for down payment. You'll have to qualify for a mortgage amount of $850,000. That is your $1.1 million less $250,000 down payment. On a side note, even if you are adding the mortgage helper suite, you can't use the potential income from that mortgage for qualifying. Once your offer is accepted, you'll have to send in your contractor to provide you with that firm quote for $100,000, which is subsequently approved by the lender. On the completion day, your lawyer will receive $850,000 from the lender, but will hold on to $100,000 of it. They have a special account for this called a trust account. Then you move in and send in your contractor. Immediately after the contractor's finished his work, they will give you an invoice confirming that the work is done and the quote has been completed. You give that invoice to your broker who forwards it to the lender. The lender then authorizes your lawyer to release the $100,000 to you so you can pay your contractor. Whichever option you choose, always make sure that you fully understand the interest rates and fees associated with it and consider it in the cost of your renovation. Whichever option you choose, make sure you have a plan to pay back the loan. With careful planning and consideration, you can finance your home renovation and create the home of your dreams. Thanks for watching.